Okay, let's consider now this concept of the global market portfolio. The global market portfolio is often the basis for asset-only allocation approaches. Okay, it's going to be your starting point. Now, it's a bit theoretical, this. Right? Imagine all investable assets anywhere in the world. Well, together, that comprises the global market portfolio. Okay, it's the most diversified portfolio possible. It contains all available risky assets anywhere in the world. You might remember back to levels 1 and 2 when we looked at capital market theory, the CAPM formula, or the global market, the return in the market portfolio. This was what we were talking about, the GMP. So if you think about it as being the most diversified portfolio possible, if you use it as the starting point of your asset allocation decisions, what it does, it gets rid of automatically any investor biases. You may have home country bias, you might have a value or a momentum or a growth bias. Well, if you take your global market portfolio as a starting point, there's no bias in there at all. And then to depart from those global weightings, you really have to justify it. It's forcing you to examine your own biases, which makes it a very useful tool when dealing with asset-only allocation decisions. You can, of course, depart from the global market portfolio if your client really wants to have a home country bias. Well, as long as you can discuss that with them and there's a reasonable justification for doing so, then you can tilt the global weights towards your home country. If the client really wants to get out of social and environmentally suspect investments, well, let's do that as well. But as a starting point, very useful for scrubbing any bias at all, and then we can put the biases back in as long as there's a reasonable investment justification for it. Nice in theory, often a lot more difficult in practice. How many times have we said that during the CFA studies? So what are the challenges? Well, the global market portfolio contains all assets in the world, all risky assets in the world. It's very difficult to get information, particularly with non-traded assets. How do we know the value of unlisted shares or even unlisted bonds? So really just a lack of available information is a problem on those non-traded assets. So lack of available info. We're talking all asset classes in the world, so things like residential and commercial real estate are there. Well, it's pretty difficult for an individual investor to buy a chunk of residential real estate, isn't it? If I've only got $1,000 to invest, I can't exactly buy a portion of someone's house. So there are some practicalities involved. Now we know that there's real estate investment trusts out there, but they don't fully replicate the exposure that we would want in the global market portfolio. Likewise, commercial real estate and private equity. Usually the required investments just to buy one unit of commercial real estate or one share in a private equity fund, they can often be very high. So there's a lack of liquidity and a lack of ability for small investors to expose themselves to those asset classes. Yes, there are proxies, so we have exchange-traded funds which try to mirror the global market portfolio, and they make a reasonable approximation of it, but it's not going to be perfect. And just from a theoretical versus practicality standpoint, we have to recognize that, like a lot of things in capital markets, you can't perfectly replicate the theory in practice. Okay, so let's imagine now that we've come up with our optimal asset allocation. 25% equities, 25% bonds, 25% real estate, and 25% in commodities. There we are, a nice simple asset allocation. That is our decision. So we implement it. We implement that asset allocation decision and we implement it using index funds. Okay, so if it's global equities, we'll buy some index funds which mirror the performance. If it's global commodities, yes, there's commodity indices available. We'll cover that in the commodity study sessions. So we fire and forget. We implement the asset allocation and we sit back and forget about it. That would be the most passive approach. The most active approach, completely the opposite. Yes, we'll implement that strategic asset allocation decision initially, but then we're going to be constantly varying it. We're going to be doing a tactical asset allocation, short-term deviations, seeking to add value. So instead of being 25% equities, 25% bonds, we might short-term shift into 40% equities and 10% bonds. And then we'll shift back once our expected performance of the market has come to pass. How about even more tinkering and more active management? Dynamic asset allocation. Okay, so these are going to be more longer term deviations from the strategic asset allocation based on long-term views. Really, you're departing for a substantial period of time. Begs the question, is the strategic asset allocation still appropriate? So based on the fund manager's expectations for capital markets, they will, to a greater or lesser extent as we move along, the passive to active spectrum, they'll be making those decisions to deviate potentially. The most active approaches would also use active management within each asset class. That's not just changing the weightings, 40% equity, 10% bonds, but that's looking at individual securities within that asset class and actively chopping and changing. Individual security selection, a much more important part of active management, trying to squeeze extra returns out of each individual asset class. In reality, of course, those are two extremes. Okay, so in reality, most investment approaches will be somewhere along this spectrum. Okay, so there'll be a mixture of index-based funds and maybe a little bit of short and long-term deviations as the investment manager deems appropriate. Now, what happens as you move from the passive to the active? Well, if you move along the arrow, you're going to get more tracking error. Tracking error, we're going to see defined as active risk. Okay, the risk of achieving returns that are different to the benchmarks. Well, of course you are. If the most passive approach is using index funds and the active approaches are deviating from that, then you're going to have an increase in tracking error, active risk. The reason you're doing it, the reason you are departing from that passive approach is to try and increase your return. So expected return should go up. Value added is, again, active return, okay, which is the return on your portfolio over and above the return of the benchmarks. But the downside, of course, is costs, or one of the downsides. You're going to be paying your investment advisor to make more decisions, to use their brain a lot more, to do a lot more work, trying to identify sources of extra return. So the more active your approach, the more it's going to cost you. As an investor, the more the investment firm is going to charge. Okay, so as an investor, what are you going to think about when you're deciding what asset allocation, is it passive or active, that you want? Well, there's going to be quite a few criteria here. First off, you might be tempted with a passive approach, but that's only going to be possible if there's suitable index vehicles. Is it possible to replicate a benchmark? If not, then you're going to be tempted to go active straight away. If there are those investable indices available, then passive is still very possible. There is a bit of a downside sometimes with active management that very large investments can suffer diseconomies of scale. Okay, so the value added by an active strategy, it can decline when the investments reach a certain level. So just something to put you off going very active. Objectives and constraints. Okay, so the passive approach may be inconsistent. Hinted at it a little bit earlier, but let's say we're implementing a fully passive approach. There's a lot of equities in there, and the client has some ethical and social considerations. They don't want to be invested in fossil fuels. They don't want to be invested in tobacco. Well, if you try and replicate an equity index, the chances are there's going to be fossil fuels and tobacco stocks in there. So in order to make sure that you're meeting those ethical and social considerations, you're going to have to take an active approach and alter the precise constitution of that index fund. Is the market efficient? Well, if so, don't go with an active approach. An active approach is useless. Remember, with an active approach, what we're trying to do is maximize returns. We're effectively trying to beat the market. If we think a security is undervalued, we're going to buy it. That might involve departing from our strategic asset allocation. Well, there's no point in doing so. If the market's strong form efficient, all of the securities are automatically fairly priced. But of course, in reality, markets are not perfectly efficient all of the time. Basically, the lower the efficiency of the market, the greater the potential returns are from an active management approach. Okay. A good active manager will generate active returns, okay, value added, but those value added returns to the investor might get eroded by costs, particularly transaction costs. Every decision an active manager makes, buy that security, sell that one, okay, change the weighting, 10% from equities into real estate, that's going to cost. Okay, there's going to be transaction costs, there's going to be costs for the advice, so the investor's actual net benefit might end up being eroded by the cost of those decisions. And one practical element of this is tax. Okay, so the more turnover there is in the portfolio, the more buying and selling decisions. Well, if you're buying a stock if you're selling a stock that you bought a little while ago and you're making a gain, well, that will generate a tax liability in many countries. There's going to be a capital gains tax to pay. Okay, so the more frequent the transactions, the greater the chance of taxable gains coming into play, and you have to pay tax on those. Effectively, it's just a practical implementation of the cost of those active decisions. But the higher the tax rate, particularly on capital gains, well, the more tempted you'll be to stick to a passive approach. You're going to defer those capital gains until the end, so the present value of the tax is going to be lower. Okay, no one of those factors trumps the others. They're all things that would be considered when deciding to go for active or passive. Okay, finally here, just a trailer for what's coming up a little bit later, the idea of risk budgeting and rebalancing. There's a little bit of overlap in the CFA readings, so we've decided to keep our coverage of both of these topics towards the end of the study session. So we're not going to say too much about it now, other than to say watch out for it coming up, and to define both concepts. So risk budgeting, well, like any budget, you're deciding how much of something you have and how much of it you want to spend. Well, a risk budget is defining how much risk we want to take and where to take it. So what type of risk? Is it going to be variance, standard deviation, value at risk, lots of different risk measures? We're going to decide how much of each risk we want to take, or how much of one or more of these risks we want to take, and where we want to allocate that risk in our portfolio. So that's the idea of risk budgeting. Rebalancing is really key to the monitoring and feedback process. It's a process of restoring the portfolio weights to the strategic asset allocation. Let's take a very simple asset allocation, 50% equity, 50% bonds. Well, in a year's time, if equities returns are higher than bonds, our market value of our portfolio is going to be greater in equity than it is in bonds. So every so often, we're going to have to rebalance that portfolio to the original strategic asset allocation if we consider that still to be appropriate. Okay. Remember, the asset allocation policy will be found in the IPS, monitoring and feedback, fundamental part of the investment management process, and rebalancing is an important part of that.